Welcome to the deep dive, where we plunge headfirst into complex topics, distill the essential insights, and really aim to give you that aha moment that connects all the dots. Today, we're tackling a really fascinating high-stakes question in the world of stock investing. We're talking about Alibaba Group Holding Ltd, BABE.
Right, Bob. A company that, perfectly encapsulates this fundamental tension we're seeing play out in today's markets. Our mission for you today is, well, to unpack why Alibaba's stock is trading at such a significant discount, especially despite its, let's face it, undeniable market dominance and pretty robust financials.
Yeah, the numbers look good on the surface.
Exactly. So we'll explore what crucial elements the market might be missing, or perhaps what deeply embedded risks it's actually, and maybe correctly, reflecting. Our goal is to clarify these powerful opposing viewpoints and provide you with a much clearer picture by the end of this.
And what a captivating picture it paints. Our sources immediately throw us into this tension. Deep value amidst pervasive pessimism. It sounds almost like a riddle, doesn't it?
It really does.
A giant of commerce, trading at a discount so steep it almost defies logic. One report sees it as a, quote, compelling, high-risk, deep-value investment opportunity.
While others describe it as plagued by unavoidable and unquantifiable risks, that phrase really jumps out.
It does. This
Yeah.
isn't just interesting. It feels like a mystery we need to solve. So we'll be exploring both sides of this coin today.
Mm.
Okay, so, all right, let's start with the bull case then. For those people seeing deep value, what's the core of their argument? What makes Alibaba look so compelling right now?
Well, first off, it's really vital to grasp that Alibaba is far more than just, an e-commerce company. That's maybe the first misconception.
Okay.
What we're looking at is a truly vast, integrated digital ecosystem. Think about it. You've got Taobao and Taomou Group, TTG, that's the heart of the empire, right? It brought in about 41% of its fiscal year 2024 revenue. Significant.
41% just from that core.
Yep. But then there's the Cloud Intelligence Group, Alibaba International Digital Commerce, Cainiao Logistics, Local Consumer Services, even digital media and entertainment. They basically built an entire digital world.
So, yeah, it's not just a shopping website. It's practically a digital economy unto itself. That's a huge distinction many might miss, I think.
Precisely. And a key differentiator here, connecting this to the bigger picture, is its asset-light marketplace model.
Ah, right. Unlike Amazon, maybe.
Exactly. Unlike Amazon's direct retail model where they buy and hold inventory, Alibaba largely acts as an intermediary. It connects millions of merchants with hundreds of millions of consumers. This approach means highly diversified revenue streams. You've got customer management revenue that's basically advertising and marketing fees.
Okay.
Commissions from sales, cloud computing fees, various membership fees. They're facilitating the transactions, not holding mountains of inventory themselves.
Less heavy lifting in one way, perhaps, but I imagine a different kind of complexity when you're managing interactions for, over 1 billion customers. It's a truly unique beast.
Absolutely unique.
Now let's get into the numbers, because you mentioned the robust financials. On paper, Alibaba looks incredibly strong. This is where it gets really interesting for the bulls, right?
It genuinely does. The company maintains what our analysis calls a pristine balance sheet. Let me give you some figures. In fiscal year 2024, they held CNY 649.3 billion in cash and short-term investments.
Wow.
And that significantly exceeds their total debt, which was around CNY 170.1 billion.
Huge difference.
It translates to a remarkably low debt-to-equity ratio of just 0.25. I mean, compare that to an industry average often below 1.0. This financial fortitude is a key defensive characteristic. It's like a massive war chest.
A huge cushion, definitely. But, in such an unpredictable market, especially with the China context, does even that level of financial strength offer enough insulation against those unquantifiable risks we're going to talk about later?
That's the core tension, isn't it? That's the million-dollar question, or maybe the multi-billion-dollar question here. But sticking with the bull case for a moment, this isn't just static cash sitting there. It's actively generating more cash. Alibaba delivered a robust CNY 157.6 billion, that's roughly $22 billion US in free cash flow in FY 2024 alone.
$22 billion free cash flow.
Yep. And this financial strength also supports aggressive shareholder returns. They've been doing substantial share buybacks and, crucially, they've just instituted a dividend.
Ah, the dividend is new. That's interesting.
It is, and it signals real management confidence, plus it provides a sort of tangible floor potentially for the stock price,
Yeah.
something concrete for investors.
Okay, so strong financials, generating cash, returning some to shareholders. But if parts of the core commerce business are maturing, maybe slowing down a bit, where does Alibaba expect to find its next big wave of growth? Are these new engines really viable long-term bets?
That's a critical question, and the strategic pivot to high-growth engines is absolutely central to the bull thesis. The cloud intelligence group, Alibaba Cloud, is key here. It's already the market leader in China and a significant global competitor. And it operates in an industry projected to see like 16–20% compound annual growth through 2030. That's huge growth,
16 to 20% CAGR, that's a strong tailwind.
definitely. And Alibaba's explicit AI-driven focus with its own large language models like Tongyi Qinan or Qin, well, that positions it to capitalize on this massive secular trend of digital transformation. The potential for these segments, cloud and AI, to monetize much more effectively is considered quite high by the bulls.
Right. And what about its competitive advantages, its economic moat? We've talked about it being a giant, but how defensible is that position now? Is that moat still as wide and deep as it used to be?
Yeah, that's fair. Historically, Alibaba has benefited from a very wide economic moat. Its key sources are, first, powerful network effects. You've got over 1 billion consumers attracting millions of merchants, which in turn attracts even more consumers. It's that powerful, self-reinforcing link.
The classic network effect. Hard to replicate.
Very hard. Then you have intangible assets. The Taobao and Tmall brands are household names across China. Huge brand recognition. Plus, they possess these vast data sets on consumer behavior, giving them an edge in personalization and advertising.
Data is the new oil, as they say.
Pretty much. And as we mentioned, that asset-light marketplace model offers significant cost advantages compared to direct retailers like JD.com, allowing for potentially higher margins. So the moat is there, but, and this is important, it is under pressure. We'll get to that.
Okay. So, given all these strengths, this vast ecosystem, a fortress-like balance sheet, clear growth engines in cloud and AI, a solid, if maybe slightly pressured, moat-wide, the deep value part, why is the market giving it such a steep discount? Where is this profound disconnect coming from?
Right. And here's the real aha moment for anyone looking closely at Alibaba from the bull perspective. The market is essentially pricing this dominant cash-rich company as if some kind of catastrophe is almost inevitable, despite all these deep-seated strengths we just discussed.
Pricing in the worst-case scenario, basically.
Pretty much. A discounted cash flow model in one of our source reports suggests an intrinsic value of around $152.50 per share. But what's even more telling, I think, is comparing it to its own history. Alibaba's current trailing 12-month enterprise value to sales ratio is about 1.9x. Its EV to EBITDA is around 10.0x. Now, compare that. Those numbers are substantially below their respective 5-year averages, which were 2.81x and 13.68x.
Wow, that's a big drop from the historical average, not just a little dip.
Exactly. It's not a small dip. It indicates a severe and sustained derating by the market, a fundamental shift in perception.
That's not just a discount. That feels like a wholesale reevaluation by investors. It really makes you wonder what extreme scenario the market is embedding into that price.
It does. And the synthesized fair value range from our sources puts it somewhere between $140 and $160 per share. So this is the core of the bull case, the idea that the market is pricing in an almost unwarranted level of pessimism, overlooking these powerful fundamentals and suggesting a significant mispricing opportunity.
Okay, that lays out the optimistic view really clearly. But now we absolutely have to flip the coin. What exactly are these unavoidable and unquantifiable risks that are causing such a dramatic derating? Why is the market so pessimistic about a company with all those formidable strengths?
And this is where the conversation gets, let's say, much more cautious. That's the crux of the bear argument. First, there's just intense competition. Alibaba's moat, while wide, is definitely under siege.
Under siege, okay.
Then China's e-commerce market isn't the Alibaba JD duopoly it maybe once felt like. It's transitioned to more of a Big Five scenario. You've got fierce rivalry from JD.com. With its direct sales model, strong logistics, they hold about 16.9% market share.
Right, JD is a major player.
Then there's Pinduoduo, PDD, a really formidable challenger with about 13.2% market share. They're known for social commerce, group buying, and they boast an incredibly impressive net profit margin, 28.55%, much higher than Alibaba's in some segments.
PDD has really shaken things up.
They really have. And you can't even discount Tencent. Through WeChat mini programs and WeChat Pay, they act as a powerful indirect competitor, facilitating commerce within their own massive ecosystem. All this has led to, frankly, market share erosion for Alibaba in some areas and costly price wars, particularly in adjacent sectors like food delivery. This directly pressures Alibaba's profitability.
So they're fighting a multi-front war, which definitely eats into margins and forces investment just to stand still sometimes. But for Chinese tech, the regulatory environment, it always feels like the sword of Damocles hanging over everything. How big of a factor is that here?
Huge. This is, without a doubt, arguably the single greatest risk. The Chinese government has demonstrated very clearly its immense power to reshape the tech industry fundamentally.
We've seen that play out.
Yeah, whether it's through antitrust crackdowns, stringent data security regulations, new controls over financial technology, it creates this permanent cloud of uncertainty. And what that means for you, the investor, is that future regulatory actions could materially impact Alibaba's business at pretty much any time, with little or no warning. And there's just no clear pathway to quantify that risk beforehand. It's unquantifiable, like the report says.
Unquantifiable and unavoidable. And beyond domestic policy in China, the broader international stage must play a role too, right? U.S.-China relations.
Absolutely. Geopolitical tensions between the U.S. and China add another really significant layer of external risk. We're talking about the potential for further tariffs, investment restrictions.
Things that could directly hit their bottom line or expansion plans.
Exactly. Or even limitations on Alibaba's access to critical technologies like advanced semiconductors. These are vital for its AI and cloud ambitions. Any disruption here could severely hamper its growth plans in those key areas we just talked about.
So those are all major external pressures. But what about the company's fundamental structure itself? I've heard worries about something called the VIE structure that foreign investors need to understand. How problematic is that? Is that risk overblown?
Well, when we look at governance, the variable interest entity, or VIE structure, is, well, it's highly problematic from a traditional Western investment perspective. It's a primary reason for this persistent China discount you see on many stocks.
Okay, explain that simply. What is it?
So, foreign investors like us buying BEBA shares on the New York Stock Exchange, we don't actually directly own the core operating assets in China. Those assets, because of Chinese regulations on foreign ownership in certain sectors like tech, are held by a separate Chinese company. Instead, we invest in a Cayman Islands domiciled entity, the one listed on the NYSE, that has a series of contractual agreements with the Chinese operating company. These contracts are meant to simulate ownership, giving the Cayman entity control and economic benefits.
Contracts, not direct ownership. Okay, I see the potential issue.
Exactly. This complex and, frankly, legally ambiguous structure carries what's called tail risk. It's the rare but potentially catastrophic risk that the Chinese government could one day just deem these contracts invalid.
And if that happened?
Well, potentially, the shares held by foreign investors could become worthless overnight. It's a low probability event, most argue, but the potential impact is total loss.
That's a truly chilling thought, a risk that investors in, say, U.S. or European companies simply don't have to factor in. It really puts a different spin on what ownership actually means in this context.
It absolutely does. And the governance concerns don't stop for the VIE structure.
Yeah.
There's also the Alibaba partnership.
What's that?
It's a self-selecting group of about 30 senior managers within Alibaba, and they have the exclusive right to nominate a majority of the board of directors.
Wait, so insiders nominate the majority of the board, not the shareholders?
Effectively, yes. This structure essentially cedes control to insiders and significantly diminishes the rights and influence of public shareholders. So even if that catastrophic VIE risk never materializes, your influence as a shareholder is already somewhat curtailed compared to other companies.
So that impressive financial strength we discussed earlier, that huge pile of cash, does that come with any caveats from the bear perspective? Could there actually be a downside to having so much cash?
It's an interesting point that our report highlights. Capital allocation risk. It's a potential downside. Alibaba has historically used the immense profits generated from its core commerce business to fund, well, speculative and often loss-making ventures in other sectors. Think digital media, local services, etc.
Try and find the next big thing, I suppose?
Right. But if these investments consistently fail to generate adequate returns, it could be seen as value destruction rather than creation. You're taking profits from the golden goose and potentially pouring them down the drain. This strategy also has the effect of masking the true profitability of the core business, making it harder for investors like you to assess what's truly working well and what's just burning cash.
Makes sense. Harder to see the underlying engine's performance. And finally, there was a point about beta, a metric many investors rely on for risk assessment. The report called Alibaba's beta highly misleading. Can you shed some light on that?
Yeah, this is an important technical point. Zooming out for a moment, Alibaba's 5-year beta is listed as 0.16. Now, beta typically measures a stock's volatility relative to the broader market, like the S&P 500.
And a low beta usually means lower risk, less volatility compared to the market.
Usually, yes. But for Alibaba, that low beta is highly misleading. Why? Because its stock price volatility isn't really driven by broad market movements in the U.S. It's overwhelmingly influenced by idiosyncratic, event-driven factors specific to China.
Like sudden regulatory announcements we talked about, or shifts in geopolitical sentiment.
Exactly those things.
Right.
They cause big swings in Alibaba's stock that have almost nothing to do with whether the overall U.S. market is up or down that day. So you should absolutely not interpret that low beta of 0.16 as an indicator of low risk.
That's a crucial clarification. The real risks here are political and regulatory, and they're just not captured by that standard statistical measure.
Precisely. The beta doesn't tell you the real story here.
Okay. Wow. So what does this all mean for you, the listener, the investor, grappling with these powerful opposing forces? On one hand, undeniable financial strength, dominant market position, exciting growth potential in cloud and AI. On the other, these really significant, hard to quantify, and maybe unavoidable risks related to competition, regulation, geopolitics, and even the fundamental ownership structure. It's a genuine dilemma.
It really is. And the analysis concludes there is a profound disconnect between Alibaba's current market price and what its fundamental intrinsic value might be based on those strengths. The market is, in effect, assigning very little, maybe even close to zero value to its cloud leadership and its significant AI potential.
Yeah.
And it seems to be overlooking the company's fortress-like balance sheet
Yeah.
and its powerful ability to churn out free cash flow.
So the argument is the bad news is already baked in.
From this perspective, yes. The pessimistic case, with all its regulatory and competitive anxieties, appears to be fully priced into the current stock level, maybe even overly so.
Okay. So for those looking at this from an investment perspective then, what's the core belief underpinning a potential investment now? What's the strategy if you lean towards the bull case?
Right. The investment thesis, as laid out in our source report, really hinges on the belief that two things will happen over time. First, an eventual stabilization, or at least clarification, of the regulatory environment in China. Second, the successful monetization of those high-growth engines, particularly cloud and AI. If those happen, the belief is it will catalyze a significant re-rating of Alibaba's valuation multiple. Its PE ratio, its EV/EBITDA ratio, would likely expand,
Moving it closer to its historical average, perhaps.
or at least moving significantly off these current lows. And that re-rating, in turn, would offer substantial upside for investors. But, and this is key, investors with a high-risk tolerance and a multi-year investment horizon. This isn't a short-term trade idea.
High risk tolerance and patience. Got it. So what are the key catalysts investors should be watching for? What specific things could trigger such a re-rating and finally close that valuation gap?
Yeah, the report lists a few crucial ones. First, successful AI and cloud monetization is huge. That means demonstrating consistent growth and improving profitability in those divisions. Seeing successful integration and adoption of models like Tongqi Qianwen would be positive signals.
Showing that the investment is paying off.
Exactly. Second, any credible indication from Beijing that the era of intense regulatory crackdown that's an indicator for sentiment.
Signal of stability.
Right. Third, successful restructuring. Things like potential spin-offs of divisions, like Cainiao Logistics or the Cloud Intelligence Group itself. These could unlock value that's currently hidden within the conglomerate structure.
Making the individual parts easier to value.
Precisely. And fourth, of course, the continuation of aggressive capital returns. Continued share buybacks and those regular, potentially growing dividends provide tangible shareholder value that the market can't ignore forever, especially if the price stays depressed.
Okay, those are the potential positives. But staying balanced, what are the key headwinds that investors absolutely need to keep watching out for? What could derail this whole thesis?
You absolutely must keep an eye on the persistent competitive pressure. Intensified price wars could further erode margins, even in the core business.
So watching PDD and JD closely.
Definitely. Also, a deeper, more prolonged macroeconomic weakness in China is a major risk. That could significantly affect consumer spending, which is Alibaba's lifeblood.
If consumers aren't spending, Alibaba suffers.
Directly. Geopolitical escalation is another big one. New U.S.-China sanctions or investment bans remain a critical and unpredictable risk factor. And finally, a failure to execute on its AI ambitions. If Alibaba falls behind competitors in AI development and deployment, that would fundamentally undermine a key part in the future growth narrative.
So after this really comprehensive deep dive, weighing both the incredible strengths, the financials, the ecosystem, and these very real complex risks, regulation, competition, VIE, what's the ultimate verdict from our source material? What's the actionable takeaway, the plan for an investor considering BABA?
The report lands on a clear recommendation, despite all the risks. BUY.
A buy rating.
Yes, and it sets a 12-month price target of $155 per share. Now, it's important to understand how they get there. Achieving this target doesn't necessarily require a return to the frothy peak valuations of the past.
Doesn't need to go back to 2020 levels.
No, rather, it implies a modest re-rating from current levels as the company demonstrates progress on those strategic fronts we discussed: cloud, AI, capital returns, and hopefully, as the regulatory outlook stabilizes somewhat. But, and the stress is this advice is specifically for an investor with a long-term perspective and, crucially, a high tolerance for volatility and geopolitical risk. It's really not for the faint of heart.
Understood. High risk, potential high reward, long time frame. What an absolutely fascinating deep dive. We've seen such a clear case of a dominant company caught right in the middle between undeniable financial strength on one side and these significant, hard-to-quantify risks that have just hammered its valuation on the other.
Indeed. It really boils down to this.
Yeah.
The ultimate question for you, the listener, is whether you believe the market is currently overly focused on the shadows, on the risks, or if it's truly underestimating the long-term earnings power and the strategic pivots happening within Alibaba's vast ecosystem. Hopefully this deep dive arms you with the insights and the different perspectives you need to form your own informed opinion.
So maybe consider this as you reflect. In a world flooded with information, where do you personally draw the line between a genuinely undervalued asset, where the market has simply gotten it wrong for a time, and a value trap, where those risks are real and likely to permanently depress the price? How do you weigh something as unpredictable as geopolitical uncertainty against something as concrete as proven cash flow and clear market leadership in your own investment decisions? It's not easy.
It's definitely not. If you found this deep dive valuable, untangling this complex web, imagine having insights like this delivered to you regularly for all sorts of challenging topics. We really do strive for those aha moments in every deep dive we do.
So make sure you subscribe to the deep dive for the fastest and most frequent updates. We aim to bring you unparalleled clarity and those fresh perspectives on the issues that matter most to you. We'll see you next time.